This is CatsMeow492, and today we are going over Introduction to Indicators. Now, if you like the charts and the platform I used to trade on, there's a referral link to Webull down below, and please like and subscribe if you're cool. Now, there are two basic types of indicators. There are leading indicators like RSI, Stochastic Oscillator, KDJ, and Net Volume, and there are lagging indicators like the MACD and the Aroon. So let's go over the pros and cons for both. Leading indicators, the pros are they signal before market trends most of the time. They're great at identifying entries, great at identifying upcoming reversals, and they can be the canary in the coal mine to your entire strategy. The cons are there's a lot of signal noise, a lot of nonsense, very little info about prevailing trends, and they're hard to read. Pros for lagging indicators are much less signal noise, easier to read, more accurate on long intervals. Cons are useless almost entirely on short intervals, and the signals are often late, leaving you with bad entries. So let's go over a couple example indicators, starting with the Relative Strength Index, which is a leading indicator. Now it's calculated in 2 steps, and they are both very confusing and very long steps, and you can see them at the blackboard. So why is this important? Well, it's not at all. So let's just go over what we need to know to trade with the RSI. When there's an uptrend, you want to buy when the RSI is 30 or below and sell when it's 70 or above. When there's a downtrend, you want to short when the RSI is 70 or above, or close when the RSI is 30 or below. However, RSI by itself is not a strategy. Okay, so let's get started with RSI here. Now, RSI in Webull goes down here in this subchart and is on a scale from 0 to 100 and is almost never 0 to 100. Now, in general, when the RSI is below 30, that is considered very oversold and that the market is probably due for a bull run. Not always, especially in short intervals, it can just sink down below 30 however long it wants. But if you have a general market uptrend, like we mentioned earlier on the blackboard, if you can get in below 30, that is considered a good long or call entry. If you have a prevailing downtrend and you can short or buy a put while it's above 70, and 70 is when it's considered decisively oversold, then that is considered a good entry. Now you can see how RSI is almost always used on shorter intervals to determine entry. So let's look at this recent little uptrend here. Now as you can see, the RSI dips low here, and I gotta mention, you rarely get the miracle scenario where you have a general uptrend and you can get in with the RSI below 30. So being realistic here, I typically say if it's under 45, you don't have a bad entry. You just need to be careful with your stop loss. So as you can see here, the uptrend starts. We've got an RSI of 30.47. So just really on the end of oversold, but just barely above that magic 30. So then we trend up, we trend up, we trend up, we trend up, and the RSI approaches overbought here. Now that's another good sign that maybe it's time to take an exit. If you're a short-term trader like I am, I usually trade within intervals of about anywhere from like 30 seconds to 15 minutes. So as soon as I see a good exit, I take it usually. Anyways, we go back down here and then 44.52. Now you remember how I said a second ago, you rarely get those below 30 entries on an uptrend. Well, 44.52 isn't a bad one. So you can say you went long or bought a call there, and then it trends up, it trends up, it trends up, and then that was the end of the day. So maybe if you were holding on to that position, you'd hold out till the RSI was up to about 69, 70, something like that, and then get rid of your long or call position and look for another entry below 45. Now the last thing worth mentioning here is on that chalkboard video, I mentioned that leading indicators often have signal noise. Well, what I mean by that is there's very little smoothing in the data. So you can see RSI is all over the place. A lot of times if you find yourself in a position where you're trading alone on this strategy, you're going to have reoccurring panic attacks because it is up, down, and all over the place usually. And it is worse when you're watching these tick in. So it is always best to pair a leading indicator with a lagging indicator somehow. We use the lagging indicator to find the trend. we use the leading indicator to find entries. All right, time for the moving average convergence divergence, also known as the MACD or MACDaddy. The MACD is a lagging indicator, meaning it is usually behind the market. The math is kind of complicated, so fuck that. All you need to know is it uses two exponential moving averages, usually 26 and 12, and has a histogram that represents the convergence or divergence between the moving averages. If the 12 is over the 26, the market is bullish. If the 26 is over the 12, the market is bearish. And it's used on longer intervals to determine prevailing trends. The MACDaddy is generally a very noob-friendly indicator, and it is best used on longer intervals. I find it almost entirely useless on any interval below 1 hour. But let's get started with the daily. We're using it with the daily. Now, the MACD, like the chalkboard said, has two moving averages. This yellow one is the fast moving average. This blue one is the slow moving average. When the blue one is over the yellow one, it is a bearish trend, and you'll have these red histograms. That's what these are called, these little bars in between here. And these histograms essentially represent the difference between the slow moving average and the fast moving average. When the difference between these is negative, you have a red histogram, aka bearish trend. Now, when the yellow is above the blue, you have a bullish trend. And you have these nice little easy to read green histograms. Now, generally, when we enter, we want to see increasing divergence between these. So say we took a short entry right here, because the crossover with the MACD is your buy or sell signal. So when your yellow crosses over blue downward, you have a short or a put entry. Now, generally, you want to see increasing divergence once you enter that position. And you can see here at the very end, there's a lot of convergence here. So that means the long-term trend on SPY in this case may be reversing. And then when you get the yellow crossover blue, it is a long or a call entry. And you can see on longer intervals, the MACD does not do a terrible job. If you were trading alone on this one, you would have bought here, right? Held it all the way up to here, and then sold or entered a put or ordered a put, and then you would have gone all the way to here, and you probably would have just exited your puts. And you can see on that alone, that's a pretty profitable trade. Now, if you're looking to trade with this on shorter intervals, I will show you it is almost entirely useless. So let's go to the 1 minute. On the 1 minute, it reverses so much, it's almost impossible to trade on. I guess you could make a little bit, but when you look at your entry here, right, what is the difference between here and there? It's marginal. It might even be the same number. Your trade's probably going to get eaten alive by commissions. So the MACD is not very useful on 1 minute, and you'll find that it's about the same way on the 5 minute and the 15 minute. You're best off using the MACD on 1 hour and above. All right, the final indicator we will be going over is the Aroon, which will also probably be the easiest. It is a lagging indicator, just like the MACD. It has two lines, an up line that measures the time between highs and a down line that measures the time between lows. If the up line is above the down line, the trend is bullish. If the down line is above the up line, it's bearish. Easy, right? Okay, so now we've got the Aroon on the same chart as we had the MACD on. The nice thing about the Aroon is that it's very simple to read. It's very noob friendly. So you can see on this chart, we have a yellow line and a blue line. And if you remember from our chalkboard, the blue line is the up line and the yellow line is the down line. So here we have a crossover where the down line is over the up line. It's a very simple sell signal. That's all there is to it. It's just a sell signal. The Aroon does not give much information about the strength of a trend, increasing divergence the way the MACD does, convergence, a trend about to end or anything like that. It really just buy or sell signal. So what's great about it is it's good at just like a glance. But you'll also notice, if you remember earlier from the MACD, the MACD was actually signaling a reversal here, while as the Aroon is not. So the takeaway from that is the Aroon actually lags more than the MACD by default. Now you can change these settings so it lags a little bit less, but the signal smoothing is kind of built into this indicator, which is kind of a problem with it. But it's also much more reliable on short intervals than the MACD is. So it will reverse less. It will be more consistent with trends. Thanks for watching, guys. If you're feeling cool, please like and subscribe to the videos. It kind of helps. If you want to use any of the charts I do or the same software and broker I do, I use Webull. There is a referral link down below. If you're cool, you use that. We both get a free stock out of it, so that's a nice bonus for me. Also, if you want to see more in different indicators, I'm going to do indicator spotlights, just involving all the indicators I use in a single video. Would have been extremely time consuming, and the average viewer only has an attention span of about 5 minutes. So I just included all the good newbie indicators. So in the future, subscribe, and the next up are probably KDJ. I'll probably do one on Super Trend too. Net volume I'm also deeply in love with, so I will definitely do a video on that. Thanks for watching.